Welcome to the program, ladies and gentlemen. This is Dollars and Cents. My name is Joel Garris of Nelson Financial Planning. And of course, as we do each and every week, we've got a lot to talk about. In today's world, we have much more to talk about than we probably ever have before. We are once again coming to you from a different sort of location, if you will. We are actually taping this on Thursday morning rather than doing the show live on Sunday. Again, the restrictions at the studio are such that they do not want the hosts in to the studio, so we're doing it remotely over the phone, recording it on Thursday, and then of course it will play on Sunday. You can of course also check out the YouTube video that we are doing as well. I am shooting that now here, sitting in my office where we're calling into the radio program. I've got the Apple headphone things going on, and so we are trying to maintain a sense of consistency in a world that has become quite inconsistent, that is for sure. So on the program, as we do each and every week, we're going to give you the latest on the virus and the economic update. And then we'll talk a little bit about the rising bubble that we're seeing in the bond market, along with try and answer the question of when, in fact, are you going to see that stimulus check. We are, of course, Dollars and Cents, Central Florida's longest running radio program, recently named at the beginning of the year as one of the top 25 financial planning podcasts on the World Wide Web. Thank you for joining us this morning on the program. Since our format is on a taped version, we want to encourage folks, if they have questions, to email us during the course of the week. That email, of course, is my first name, Joel, Joel, at, that's the little A with a little circle around it, NelsonFinancialPlanning.com. So once again, if you've got questions during the week about anything to do with your money, give us an email, and that email again, my first name, Joel, Joel, at NelsonFinancialPlanning.com. So pretty easy to get in touch with us, even though we're not necessarily sort of following the traditional live format. I guess in today's day and age, we all have to adjust. So no surprise this past week, another volatile week in the market. Some days up, some days down, and that appears to be the pattern that the market is on. There's just so much that we just don't know about the economic data and the virus data, even now, where you still see projections of what may or may not happen swinging very widely. Here in Florida, we're now under a stay-at-home order, and I probably can't think of a better description in terms of what you should be doing with your investments as well. Just as we have the stay-at-home order here in the state of Florida, we would perhaps encourage that same kind of behavior as it relates to your investments, because that stay at home or stay consistent is a great way to make sure that you maintain a consistent approach with your investments. Once again, it's easy to make a decision to move out of the market. That's the easy decision. And many investors have, and we hope that that turns out well for them, but there's a tremendous amount of research that says quite the contrary. Understand the psychology. We've talked about it on the program in the past. It's easy to get out of the market. That's the easy decision, right? The much harder decision and the much more emotional decision is when to get back in. That's the harder decision, because here's the reality of it. Your best situation in terms of trying to get back in, right, is if the market is lower than when you got out. Well, if the market's lower than when you got out, the reality is that means that the headlines have only gotten worse from where they were when you got out. So human nature is not going to allow you to do that. Instead, you're going to keep waiting. You're going to keep waiting for the all clear sign. And unfortunately, the market usually anticipates that very, very quickly And so consequently, the market moves up much more quickly than what we as human beings can manage our emotions and react to. And therein lies the big detriment in terms of investor performance versus what they should be getting versus what they get over time. So just as we've now under a stay-at-home order, we would counsel you for the same kind of an approach with your investments. Stay at home with them, be consistent. Certainly, it's important to note that as with any economic disruption, like what we're going through right now, there are clearly going to be winners and losers from a business perspective. And we can already start to see kind of what the constructive destructive process that is unique to America. We've talked about that on the program before. The reality is that the constructive destructive process is somewhat unique to America, and one of the perhaps the biggest reasons why we believe it's still the leading economy in the world is that, like so many other economies, if there is a business or an industry that is faltering, oftentimes governments will go in and try and prop things up, and that's just the way that other economies work. Here in the US, that doesn't really happen, right? I mean, if there's an economy, if there's an industry that all of a sudden can't keep up, then ultimately that changes and that industry will disappear. The easy example is, right, the buggy whip manufacturers. Back 100 years ago, before automobiles, there was a lot of buggy makers and buggy whip makers, and now there aren't. And the reason for that is you had innovation, you had things change, and ultimately that constructive destructive process is at force and one of the biggest drivers of the economy, particularly here in the US over time. So I think we're already beginning to kind of see where some of the winners and losers might be, right? I mean, think of how much our behavior has had to change just in the past few weeks, how many more things we're doing online, how many online meetings, how many access to information in the cloud, and those types of things. And so it should become apparent that those companies that specialize in that infrastructure of providing bandwidth for the internet or the components behind it, those folks are probably going to be some of the bigger winners out of this going forward, because for companies, if you haven't taken the step to get into the cloud and to be able to allow your employees to work remotely, then you're very much going to wish you had done that coming into this period of time. And so once we get through this period of time, certainly there's going to be a lot of companies that say, okay, we really need to focus on that and make sure that we have the capability to be able to do that. So there will certainly be some winners there in terms of the technology, the bandwidth, the internet side of things. And then, I think from a loser perspective, unfortunately, I think we can look at what's happening as another nail in the coffin of traditional retail stores. It's very unfortunate that these brick and mortar retail stores already were facing intense competition from online retailers. This is not good when you have to shut your doors and give people an opportunity to get much more comfortable with the competition's model. And that's certainly what's happening. Those that weren't ordering stuff from Amazon, chances are they are now. So those are the kinds of things where you can start to see where the business game is going to certainly change for them, particularly like commercial real estates and REITs, those kinds of things. Pretty dramatic in terms of what that outlook would be. So as an investor, now is certainly a good time to be intentional about what you own. Not just own a sector, not just own an index, but be selective on it. Certainly, the preference would be to own larger companies over small. Larger companies have the ability to get through that. So the extent you're looking at your portfolio, those are the kinds of things that you want to look at. Now, next up, what you need to watch out for when it comes to getting too heavy in bonds? We'll tackle that topic here on the program next on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando. Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio WFLA Orlando. I'm Joel Garris of Nelson Financial Planning. You happen to be listening to one of the top 25 financial planning podcasts on the World Wide Web. Thanks to the folks at FeedSpot. We appreciate that accolade that we received at the beginning of the year. This segment of the program, we want to talk to you about what may be percolating as a bubble in a particular asset class. And that asset class is the bond market. And so we wanted to spend some time talking a little bit about that. Prior segment, we were talking about kind of that constructive, destructive process that's always at play here in the economy, and certainly important to own large companies over small in today's environment, simply because those large companies will certainly have a greater ability to get through this versus a smaller company. Also, certainly you want to be careful about owning sectors or indexes right now, because I think there's certainly going to be some winners and losers in every industry category that is out there, and you can certainly start to see some of the categories that might do very well versus others. Think infrastructure, cloud computing, all of those types of activities will emerge from this much stronger and have a much higher level of demand from businesses and individuals around the country. Meanwhile, retail, commercial real estate, be a little wary of that and its ability to bounce back. Once you go through this process of changed behavior, it's very difficult to reverse that once people have become familiar and accustomed to a change of behavior. So involving, say, for example, ordering online versus going to a traditional retail store. So certainly a lot of changes occurring out there. But there will certainly be, as there always is, some businesses and companies and business models that survive and in fact thrive, and others that will not. So important to sort of take a moment and make sure you're being selective with what you own as it relates to your investments. What is happening out there, though, is there has been a massive migration out of the stock market, as is typically the case. Anytime you see the market decline, you see people going into the bond market as the place of safe haven. And the bond market certainly is more stable than the stock market. I mean, let's face it, after all, a bond is simply a loan, and a loan is very different than being an owner in a company. If it's a loan, then oftentimes there is collateral backing that loan. In the example of a United States Treasury, right, when you purchase a treasury, basically what you're doing there is that is a debt instrument that has been issued by the United States government. What's backing it? Well, the full faith and credit of the U.S., backed by the enormous power to tax. So there's some collateral behind that type of a investment, and so consequently, bonds are considered to be less volatile than stocks. But what's interesting is, we had this period of time where the folks in the media were describing the run up in the market from 2009 through the beginning of this year, 2020, as one of the longest bull markets in stock market history. And certainly it was, and it did go down sort of in the historical pages as a long upward cycle in the markets. But what many people don't realize is that there has been a much longer bull market run in the bond market. Nearly almost the past 40 years, there has been a steady chug up in the bond market, as we've entered into this era of incredibly low interest rates. And what most people don't realize is that when you have interest rates going down, you have the price of bonds going up. So it kind of works in reverse notion. And so that predictable pattern of, okay, the US or a company issues out a bond, we buy the bond as investors, and then we get the interest, and then at maturity we get our money back. That's been a very predictable cycle for quite some time now, and so therein lies the appeal. But the problem is that when things get a little bit predictable, investors have a tendency to forget the risks involved with owning an asset class that is too heavy on the bond side of things. Not just from a rate of return perspective. There's obviously a risk-reward trade-off when you own bonds over stocks. Stocks historically have had much better return than bonds. Almost by a factor of 3 is your performance on the stock side versus on the bond side. But of course, bonds have lower volatility. So a classic trade-off in terms of return, but that's not really what we want to concentrate on in this part of the conversation, because I think there are some myths out there that exist on the bond side that it would be good to be refreshed on. And the first and chief among them is that they really are a asset class that can in fact fall. I mean, I think one of the biggest myths out there is that bond prices don't fall much, and when they do, though, they certainly do, and they do so sharply. And in both 2009 and 2013, for long-term government bonds, there was at least a 10% drop in price, because anytime you have interest rates that are starting to move up, then bond prices fall. So anytime you shift to higher interest rates, understand that there's a risk there. And in fact, you can see bond prices fall pretty sharply. 10% declines that happened both in 2009 and 2013 when we shifted gears into raising interest rates. That certainly might surprise people to the extent that they own bonds, because not only can that happen with an interest rate move, but it can also happen when the economy weakens and when corporations have less ability to pay their bonds. Ultimately, that means that the price can fall regardless of what's going on with interest rates. So make certain that you are aware of kind of how the bonds work, and that bond prices can in fact fall pretty sharply, particularly if you have higher interest rates, and also if you have tougher economic conditions. So be wary before you push a tremendous amount of your portfolio into the bond side these days, seeking safety. Understand one of the biggest myths about that is that the bond prices don't fall much. The reality is they in fact do. A next big myth of bonds and how they operate, along with another myth, is something that we will tackle in the next segment. So stay tuned through the break, and we will continue the conversation of some of the current myths that are out there that we want to try and address for our listeners, so that they realize not to shift too much on the bond side of things. So we'll do that when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando. Welcome back, ladies and gentlemen. We are recording the program on Thursday, April the 2nd, and so in light of the new virus protocol at the studio. So we are not live on Sunday morning. If you do want to ask us a question, it seems like this will sort of be our format for the next few weeks, given the 30-day stay-at-home order issued by the governor of Florida this past week. Actually, well, It was actually yesterday, or starts today, April 2nd. So what that means is that if you have a question, the best way to reach out to us is to send us an email. That email is my first name, Joel, Joel, at nelsonfinancialplanning.com. So you can send us a question at that, and we will certainly answer it on our next program. But anyway, taping on Thursday because not allowed in the studio over the course of the weekend, and so consequently we are covering as much as we can on, I guess, a short week, if you will. Talking on the program about the bond market and talking about some of the myths that bond investors have that we really want to be aware of, particularly in today's world where so much money is shifting out of the stock market and into the bond market. And we talked a little bit in the prior segment about one of the biggest myths, which is that bond prices don't fall very much. The reality is that we've certainly seen them fall, and in some cases as sharply as quick 10% declines, both in 2009 and 2013, when you get into a time of rising interest rates. Remember, bond prices fall when interest rates go up. And certainly you saw that a couple of times really over the course of just the past 10 years. The other thing that can happen is if you get weaker economic condition, corporations may not be able to pay their interest, and that also can lead to some sharp declines on the bond fund side of things. So make sure before you shift a large chunk of your portfolio over to the bond side that you double check exactly what it is that you own on that, and understand that the bond side can also be susceptible to volatility just as much as the stock side. And in particular, if it's corporate stuff or high yield stuff, those kinds of things, make sure you take a moment to really understand not just your bond position, but the bond position that you currently have. Make sure that it's not heavy on the corporate side, because those are experiencing today as much volatility as the stock market. So know the types of bonds that you own and understand that bond prices can in fact drop as sharply as any other asset class. Another thing to be wary about is that a lot of people believe that when the Fed cuts interest rates, that helps bond investors. And to a certain extent that's true, but not necessarily so, because what the Fed is directing is short-term rates. They're not affecting long-term rates. Those are really generated more by the bond market themselves and are driven more by inflation and inflationary expectations. Well, how do you get inflation? You get inflation by having high demand and low supply. Haven't really had that issue of late, but certainly you could certainly see that, particularly if just inflation increases just a little bit. Investors could certainly respond by selling bonds, which would continue to push the price down. The reality is that because the interest rates are so low, if inflation were to start at all, a lot of investors would say, well, wait a minute, the little bit of interest that I was getting is now getting eaten up by inflation. I'm now going to sell the bonds. That selling pressure can, in fact, drive down the price of your bonds. We've certainly had some mild inflation over the course of the past 10 years, and so that has certainly helped offset the fact that the interest rates are low. But if inflation starts to creep up, then you're going to have a problem if you're too heavy on the bond side. And one last comment on the bond side of things. There's a lot of folks that believe that bond funds are riskier than individual stocks. That's certainly a myth, because remember, when you own a bond fund, you have a much greater amount of diversification. If you own just a bond, granted, you know the maturity date, you know the price, you know exactly what the story is with that bond, but you're lacking diversification. And when you own a single bond or an individual bond, that's like owning an individual stock, right? I mean, a lot of stuff can happen with that. Just ask anybody who put a bunch of money into Puerto Rican bonds, and you'll know that bad things can happen to that pretty quick. So understand that certainly bonds are lower volatile asset class than stocks. But understand that there's definitely some risk there. And we wanted to just take a moment on the program and talk a little bit about some of those common myths that investors have that they are operating under these days, that at the same point in time, the bond market in a little bit of a bubble, if you will, given the incredibly low interest rates for so long, that's driving up bond prices. Remember, bond prices can in fact fall, and they can fall sharply and quickly, just like anything else. The Fed cuts can help, but they can also hurt, particularly if you wind up with having any level of inflation. That's going to cause the interest rate on those bond prices to feel like it's a whole lot less. And then lastly, of course, funds are, in fact, a bond fund is a great way to help diversify that risk rather than owning a bond. So just some comments on the bond side of things. Awful lot of conversation on the stock market these days, a lot of money going over the bond, but understand that there are risks there and understand the nature of them as well. So let's shift to some of the latest and greatest that has come out of Washington based upon the virus and the response. The CARES Act that was just passed, which is the $2.2 trillion stimulus package that the folks in Washington passed, packed with a ton of information. One of the things we touched on last week was that the required minimum distribution for the year 2020 has been suspended. So if you are required to take money out of a retirement account, and generally that's if you're over the age of 70 and a half, the Secure Act that passed at the beginning of the year actually pushed that age out to 72. But regardless, the CARES Act winds up suspending that required minimum distribution for the calendar year 2020. What it does not do, though, and this is significant, is that if you have a required distribution as a result of inheriting a retirement account, that is not suspended. You still need to take that as things stand right now. So understand that only a required minimum distribution for your own retirement account, that's the only piece that has been suspended. Now, if you already took your required minimum distribution earlier this year, then your only option is to, assuming it's within 60 days, roll that back in. That is would be considered a rollover, and you've got 60 days in which to do it. So basically, from today, you would look back 60 days. If you took your required minimum distribution during that window, then you would be able to put it back and avoid the taxes on it. If you're outside that window, at this point, you're out of luck. So know, though, that you can put it back if you've taken it out within 60 days. If it's beyond 60 days, then it does not appear that you've got an option. The CARES Act also changed folks' ability to access the retirement accounts. And so we will tackle that one next, because you've got an expanded ability to access your retirement accounts. And so we want to get to some of the details on that next on the program. So stay tuned through the break, and we'll be back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, continuing the conversation about some of the stuff that happened as a result of the CARES Act and its impact on you and your money, including coming up next, when you can get that stimulus check. So stay tuned through the break for that here on Dollars and Cents, News Radio WFLA Orlando. Welcome back, ladies and gentlemen. Dollars and Cents here on News Radio WFLA. This is Joel Garris of Nelson Financial Planning, talking in this segment a little bit more about some of the provisions of the CARES Act. We mentioned in the last segment that it did suspend the required minimum distribution for the year 2020. That does not apply if you have a required distribution that's coming out of a beneficiary IRA. That still needs to come out. Now, one of the things that it also did is it expanded your ability to access your retirement dollars and be able to avoid what would traditionally be a 10% penalty. It did that in a couple of different ways. First and foremost, it did double the amount of money that you could borrow from a retirement plan, so like a 401k. Previously, the limit was $50,000. Now it's $100,000. To the extent you need money, borrowing money from a 401k Not a great idea, but I suppose better than the alternative. If you need money, the reality is that when you take a loan from a 401k, it is not a taxable event, and now you're able to borrow at twice as much as you were before. Be careful of that, folks, because what can sometimes happen is if you then wind up losing your job, then all of that can be counted and triggered as a distribution. The only silver lining on that is that for this year, those distributions out of a retirement account up to $100,000 are exempt from the 10% penalty. Again, here's the caveat. In order to claim exemption from the 10% penalty, you've got to have been affected by COVID-19. Either you got sick, your family member got sick, you got laid off as a result of it, whatever the case may be, there has to be an impact. It's not like you can take $100,000 out of your IRA and go buy an RV or a second home because that's what you had planned on doing, and now you've got the ability to avoid the 10% penalty. It's not the case. The IRS specifically has linked the exemption from this 10% penalty to being affected by the virus. So you've got to make sure that you are affected by the virus in order to be able to take that money out of a retirement account and avoid the 10% penalty. One of the interesting things about the distribution rules as it relates to that money that you would get out of your retirement accounts is not only does it avoid the 10% penalty, but you actually have the ability to pay the taxes over the course of the next 3 years, which allows you to spread the tax implications of that. And you could also repay that money over the course of the next 3 years. So some interesting provisions on how those new distribution rules will work under the CARES Act that allow you to access your retirement dollars, avoid the 10% penalty, and in fact spread the taxes out, and even gives you the option to repay that money over an extended period of time. Typically, the rule on putting money back in and avoiding the taxes is 60 days. For this, though, it is 3 years. So some interesting provisions on that, again, have to be impacted, have to be affected in order to be eligible for the exemption. So wanted to get that additional information out there about that as it relates to the CARES Act. Now, to the next question, the question that everybody's asking: when am I going to get my $1,200? Well, okay, the reality is that will be sometime soon. Unfortunately, it's going to be sooner for some people than others. Those that have done a direct deposit on their prior tax returns are going to be the first ones to get it. And if that doesn't underscore why using direct deposit is important rather than getting the check in the mail, I don't know what does. Because the reality is that these stimulus checks are going to be sent to the bank account information that's on file with the IRS. If you don't have bank account information on the IRS, you're going to have to wait for your check. And we'll explain what that process is going to be next. But let's just recap the stimulus checks itself. It's $1,200 per person. So if you're married, it's $2,400 plus an extra $500 per kid. You've got to have income below a certain level in order to qualify. If you're single, it's under $75,000. That phases out. If you make more than $100,000 as a single person, you're getting zero. If you're a married couple, you got to make under $150,000 to get all of it. Up to $200,000 is where the phase out begins of getting less of a check. Above $200,000, yep, you're not getting anything. So understand the income parameters. Now, if you filed your 2019 taxes, that's the year that the IRS is going to look at to determine exactly whether you are eligible or not. If you haven't filed your 19, then they're going to look at 18. Once again, one of the reasons why last week we said, hey, even though the tax deadline is July 15th, it's probably going to be important for you to get your taxes done and get them filed sooner rather than later. You can file them, and if you owe, then you can still have that payment deducted out of your checking account on July 15th. So again, the IRS looking at prior tax returns. If you had bank account information on them, guess what? They're going to use it. If you don't, then you're not going to get your check as fast. And the process for those that don't, and again, all of this is a little bit of a moving target. The process for those that don't is supposedly they're going to set up a website that allows you to provide your bank account information online. So they still got to set up that website versus all the other people that, put the direct deposit information on their tax return. Boom, that's happening automatically. That's going to show up in their bank accounts. Those that didn't, they got to do a website, create the website. You got to go online and put that information in, and then you would get it direct deposit. If you are not required to file, maybe you haven't filed a tax return for a while, maybe your income wasn't enough, maybe you're just on Social Security or small retirement and hadn't been filing a tax return, they're still working on an answer there. And so you're going to be even more delayed. So we got the first group of people that, filing taxes and they've got their bank account information on file. Those are going to be the first ones to get the check. Next group, those that have been filing taxes but they didn't put their bank account information on, you're going to have a website where you can go and put that information in. Third group, those that have not filed taxes, well, that's a creation of another website, and whereby you can go online and put your information in and show that you fill out a simple form and show your eligibility for the $1,200. So understand that there's definitely a difference in terms of the timing and the sequence of when folks are going to get that $1,200. Some people are going to get it much faster than others. Again, all of this a little bit of a moving target. You all know to stay listening to the program because we'll certainly give you the up-to-date information on it as these websites and portals and things like that get created. But you don't have to do anything if you're in that first group where you filed your taxes, you've got your bank information. That first group, it's automatic. There are some steps if you don't have direct deposit on your tax return where you've got to go through some hoops. And then if you don't file taxes, probably going to have to go through even more hoops. Now, remember, this $1,200 is a gift from your Uncle Sam. I grimace because it's not really a gift. Eventually, somebody's going to have to pay for it. It's probably you, me, our kids, our grandkids, and so on and so forth. But here's the point. It's not reportable as income. You don't owe any tax on it. You're not going to have to worry about having to pay tax on it next year. You also will not have to worry about it getting used up for a prior tax bill or for a defaulted student loan because this is being treated as a 2020 tax credit or tax payment. So no taxes on it. And those of you that got your information into the IRS with your bank account, you're going to be the first group to get it. The rest of folks will have to kind of observe the process. We'll keep you updated as we know more on that and as they develop the procedures to be able to get it. But that's the timing on when those checks are coming. Should be within the next 3 weeks. That first group that has direct deposit will see it automatically show up in your bank account. So make sure you're checking your bank account for that deposit. Anyway, we're going to wrap it up and get on out of here, and hope you all have a great week ahead. Stay safe, stay healthy, wash your hands, be careful out there. All of that good advice that we're getting, please follow it so you can stay healthy and well. We'll wrap it up and get on out of here. Thanks for listening into the program. This has been Dollars and Cents with your host, Joel Garris, Nelson Financial Planning on News Radio, WFLA, Orlando.